Hello, clients and friends. Given the current economic climate, I would like to provide a brief commentary and share 5 key points with you. Number 1, this isn't 2008. As the market has experienced significant volatility over the past week, economists have begun to compare the current market situation to that which arose during the 2008 financial crisis. While acknowledging that the situation feels bad right now, we would like to remind you that this is not the 2008-2009 financial crisis. So far, the current effects on the market are far less severe than the effects of the 2008 crisis. Although the chart below shows that the financial stress indicator is the highest since that time, for comparison, as of now, stocks have fallen around 30% from their peak, compared with a 59% peak to bottom during the financial crisis of 2008. Another significant difference between the current situation and the financial crisis of 2008 is that the 2008 crisis came from systematic bad practices within the financial system. While our banks are currently on a very good footing and the current situation is inspired by a health crisis, which, however dire, will pass. The critical difference is that today, while the immediate future is uncertain, we believe the situation will resolve itself in time because it is not based on fundamental economic infrastructure concerns. In contrast, the 2008 financial crisis was a period of great uncertainty where the short, intermediate, and long-term behavior of both the market and the economy were complete mysteries and required remedial measures for years afterwards. Number 2, no clear path forward creates market volatility. The current market distress is mostly related to the uncertainty surrounding the future of the coronavirus and not underlying economic weakness. The best source of current information on the spread is Johns Hopkins, which provides an interactive world map of cases with a myriad of options for sorting, be it by total cases, recoveries, or deaths. The current areas of concern are the tri-state area, New York City, and the West Coast. While no state has more than 1,000 cases at the time of this recording, the concern is that many people who have the virus have not shown any symptoms and have not been tested, meaning that there are many more cases that have not yet been reported. The level of uncertainty will continue to create chaos in the markets, plain and simple. Number 3, uncertainty yields headline risk, which yields market volatility. In the absence of clear direction, it has become clear that investors are largely responding to headlines. Rather than calmly determining the long-term risks of the current situation, investors are basing their trades on emotions instead of numbers. This has caused significant market volatility over the past week as each day brings different news from the day before. This graph shows that the market has been experiencing significant gains and losses with seemingly no rhyme or reason. Just last week, the Dow closed down 9.99% on one day, the most since Black Friday in 1987, and locked in a point loss of 2,352 points, its largest point loss ever. On Friday of the same week, the Dow also had one of its largest point gains ever, rising 9.3% in the last 30 minutes of trading. Unfortunately, the market volatility will continue until there is a clear path forward from the present crisis. This path would likely take one of 3 forms. Number 1, a sustained decrease in cases. Number 2, a sustained decrease in deaths. Or number 3, the creation of an effective and trusted vaccine. Until then, we warn you to be prepared for almost anything. Number 4, don't sit out, however tempting it may be. The old investment mantra is to buy low and sell high. In theory, the strategy is fairly simple. Purchase stocks at low prices and sell them at higher prices. Unfortunately, implementing the strategy is much more complicated because emotions and timing issues come into play. We would like to remind you that by attempting to time the market, by selling after a potential 30% loss, you can miss out on the market's best days, which account for much of the market's gains. Looking back over the past 15 years, if you bought into the market with $10,000 in 2004 and sold out on the last day of 2019, you would have netted $26,418, a 9% annualized return. Considering that the 15-year period contained a significant recession, a 9% return is no small feat. If instead you mistimed the market and pulled your money, missing the 10 best days of the market, you would only gain $8,358, a 4.1% return, and less than half of the return achieved from keeping your money in the market. The more days you miss, the worse the numbers get. The time to get out was 3 months ago, or even a month ago, not now. So if you're antsy to do something, take advantage of tax trading, Roth conversions, and other planning opportunities instead. Number 5, the rebound will come before you know it. While the coronavirus has sent us into a bear market, it is important to remember that typically the market rebounds from epidemics quite quickly, particularly when, as here, the underlying fundamentals are strong to begin with. From this table, we can see that despite any poor performance that initially occurred following outbreaks, stocks managed to experience gains within 1 year and often sooner. In conclusion, we remind you that this is not the 2008-2009 financial crisis or anything close to it. The current fear of the market is the unknown, not structural instability. I would like to impress upon you that a recession is not guaranteed, but that if one does occur, it will most likely be short and nowhere near as damaging as the 2008-2009 financial crisis. Lastly, remember not to get caught up in the immediate. Instead, continue to think long term. Remember, our goal is not for short-term gains that can easily be lost in a day of volatility. Our goal is finding long-term gains and to protect those gains. If you have any questions or would like additional information, please don't hesitate to contact our office. We are here and ready to help. Thank you.